Welcome back, everybody. Today we're talking about Hershey's, the iconic 120-plus-year-old chocolate company whose classic milk chocolate bar and many other products have been American favorites for generations. And even in my own household, anytime that I go out to the store, my daughter asks if I'll get her a chocolate bar. And to her, that means a Hershey's milk chocolate bar and nothing else. And I don't dare mess that up. Over the past 30 years, Hershey's has a total return of over 2,800%, almost doubling the S&P 500. But like most things in the market, Hershey's has seen a significant downturn lately, coming down almost 30% since May of 2023. So is Hershey's a buy right now? Let's find out. But before we dive into the business, let's take a quick look at the stock. All right, if we jump into Seeking Alpha, we see that Hershey's is currently trading at a price of $195.04. Over the past 12 months, Hershey's is down 11.61%, and year to date, they're down over 14%. Now, Hershey's pays a dividend rate of $4.77 per share, which equals a 2.44% dividend yield. Now, if we look at their dividend summary, we see their dividend yield and payout. They have a payout ratio of 45.24% and a 5-year annual growth rate of 9.84%. They have 13 years of consecutive dividend growth. And if we take a look at that dividend growth a little bit closer, we see that over the 10, 5, and 3 year, they have really excellent dividend growth where it's above 9 and actually it's accelerating from 9.44% in the 10 year to 11.25% in the 3 year. And so not only is their dividend growth accelerating, but all three of those numbers are actually above their 5-year averages. Now, if we look at the momentum tab to see how Hershey's has performed against the S&P 500, if we go to the 5-year, we see that even with the most recent downtrend, which has been a pretty significant one, Hershey's is still outperforming the S&P 500 in the 5-year at 106 with the S&P at 62.81. For Hershey's, we see in the 10-year that around May of 2023, they were really outperforming the S&P quite handily, but since May, it's been all downhill from there, and so now basically Hershey's is underperforming. All right, so we have an idea of what their stock is doing and how it's performed, but let's talk a little bit about their business. Hershey's is a global confectionery leader that manufactures and sells chocolates, sweets, mints, and other snacks. They're the largest producer of quality chocolate in North America, and they market, sell, and distribute their products under more than 100 brand names in approximately 80 countries worldwide. And they're the number 1 provider in the U.S. confection category and the number 2 provider in U.S. snacking. And outside of just the milk chocolate bar and Hershey's Kisses, which we all know, Hershey's also has some of the most recognizable other candy and snack brands on the market, including Reese's, Kit Kat, Mr. Goodbar, Rolos.
Oh, you should live with Joey. Rolos everywhere.
As well as other non-chocolate snacks like Skinny Pop, Dots Pretzels, Twizzlers, and Bubble Yum. And the Hershey Company has a tagline, "Make moments of goodness," which I just thought was kind of cool, so I thought I'd share. So how does Hershey's actually make money? Hershey's revenues are broken down into the following 3 categories. North American confectionery. This accounted for $8.5 billion in 2022, about 82%. North American salty snacks. This accounted for about $1 billion in 2022, about 10%. And then international. And this accounted for $853 million in 2022, about 8%. Then additionally, their segment margin and growth rates are as follows. North American confectionery, growth rate was 11.1% from 2021 to 2022, and their income margin was 32.9% in 2022. North American salty snacks had a growth rate of 85.3% from 2021 to 2022, primarily driven by the Dots Pretzel acquisition, and then their income margin was 15.5% in 2022. International had a growth rate of 16.3% from 2021 to 2022 and an income margin of 12.6% in 2022. So if we take a look at Hershey's revenue growth, we see that year-over-year revenue growth is about 11.66% in Seeking Alpha, and that's the trailing 12 months compared to the previous 12 months. And that is well above their 5-year average and their sector median. And when we take a look at their revenue growth and the financials, we can see that they've had pretty consistent growth for almost a decade. Because they only had 1 year, which was 2015, that was just slightly lower than the year before. The other 9 years have all had positive revenue growth. And if you look at the year-over-year growth by quarter, in April it was over 12%, And then in the most recent quarter, it was just a little over 4%. And at this point, I don't really see that as a cause for concern because I don't know that double-digit revenue growth is what investors should expect on a regular basis. I think something in the 6 to 8% range is more likely, and it matches up with what their 5-year averages are. In terms of plans for future growth, they still see salty snacks as an area with a lot of growth potential and additional household penetration, although they had some issues in Q2 with integrating their acquisitions into the company that pushed some of their plan into Q3 and Q4 this year. And Hershey's also plans to ramp up advertising as they've invested in more capacity. They had to reduce some of their advertising spend last year because they couldn't keep up with the demand that it would generate. The Hershey's leadership team consistently talks about the balance between pushing volume versus pricing as it relates to growth. And even in the last 2 quarters, we've seen that in action. Because Q1 sales were driven primarily by volume, while Q2 sales growth was driven primarily by price increases. So how I take this is, you have a company that has extremely recognizable brands, they've had steady revenue growth for about a decade, and they have levers to be able to pull to hit their future growth prospects, both in price and in volume. To me, that sounds like a pretty solid combination. All right, so we have an idea of who they are and what they do. Let's talk about some risks. Risk number 1, a prolonged economic downturn and/or supply challenges could severely impact their business outlook. If economic conditions worsen and consumers have to cut back on discretionary spending, Hershey's could be impacted with slowing revenues. Now, personally, I think this is a little less of a risk due to the nature of their products, because we've talked about this concept of affordable luxury with brands like Starbucks and McDonald's, and I think that fits for Hershey's as well, especially with their most recognizable brands, because if you're a parent, you're not going to skip getting your kid the Hershey candy bar just because it's 50 cents more. At least, I don't think you will. But the larger risk, in my opinion, is in increased supply chain challenges and input pricing, because the cost of cocoa and sugar are at historical highs. And while Hershey's has shown good pricing power so far, which is the ability to raise prices without considerable impact to sales, there's likely a cost that eventually could be too high for the consumer. Because at the end of the day, it is a candy bar, so there's going to be a limit to that price that eventually consumers are going to hit. But Hershey's management team has addressed this, saying they have a long history of managing input costs and commodity pricing over the years. And additionally, they see price as only one lever they can pull, in addition to things like increases in productivity or efficiency in other parts of their P&L. And this is where Hershey's 120 plus year history benefits them, because this has been their business for a very long time through all kinds of economic environments. And I don't think you last that long unless you've built up competence in these areas. Risk number 2. An increase in demand for healthier food options or government mandates could severely impact their business outlook. As healthy lifestyle becomes more popular, a general shift to healthier eating and food options could follow. And currently, the U.S. is known to have some of the unhealthiest eating habits in general, but studies show that younger generations are more health conscious than previous generations. If this continues to grow, it can mean lower demand for Hershey's products overall compared to historical norms. Now, how much would this impact chocolate demand? I'm not really sure, but I do think their expansion into salty snacks at least helps a little bit, even if in general those aren't the healthiest thing either. But they have made acquisitions like Amplify Snack Brands, who's the creator of Skinny Pop, that try to bridge the gap to snacking a bit healthier. So obviously, nobody's going to confuse Hershey's with health food, but in my opinion, they only need to move the needle a little bit to mitigate a big portion of this risk. Because I don't think the likelihood of a full-scale switch to healthier eating overall is going to be that drastic or even that fast. But one thing that could impact that is the possibility of government mandates to improve people's general health that could also impact Hershey's business. And one extreme example of this is when New York banned sugary drinks larger than 16 ounces. Now, this ban has been reversed, but similar initiatives could pop up as politicians try to gain political favor or just appeal to certain voter demographics. Although I think this risk is unlikely, government intervention can happen unexpectedly if sentiment changes around an issue quickly. And I won't go into details about my thoughts on the effectiveness of our political leaders, but if you've watched this channel long enough, you probably already know my thoughts on that. Risk number 3. Increased competition or loss of critical licensing agreements could negatively impact their business outlook. Hershey's currently owns the U.S. licensing agreements for popular products like Kit Kat, Rolo, and Cadbury, as well as worldwide licensing agreements for products like York, Almond Joy, Mounds, Milk Duds, and Jolly Rancher. A loss in these agreements or not meeting the minimum sales requirements could negatively impact their business. Now, obviously, these are extremely recognizable brands and products, so the demand for them is going to be there regardless of who gets to manufacture them. But I don't think Hershey's losing the licensing agreements is likely because they have such a long history of manufacturing and distribution with those brands as well as their own. And there's probably not very many competitors who could execute it as well as they do to be able to maximize the profitability for the license owner. So it's definitely a risk, but not a big one in my opinion. But one part of the risk that has people talking is the release of differentiated products that have increased over the years and could take market share away from Hershey. And one interesting trend in this area are the creator-led food brands like Mr. Beast Feastables and Logan Paul's Prime. And this came up in a tweet from Chamath Palihapitiya where he said, consumer packaged goods are under real disruption from creator-led brands that actually earn money for their advertising of their products through popular content than having to spend millions on advertising in general. And this was really an interesting idea to me because obviously creators like Mr. Beast are doing amazing things and his snack brand Feastables has been hitting stores and selling out. Now obviously $10 million in sales is small compared to Hershey's $2 billion or so that they'll do in a quarter, but they're just getting started, and like they mentioned, their advertising budget and the cost that they're going to have to use for that is going to be way less. And that's the leverage that creator-led products have. People get to know and like a person on a deeper level than just a consumer packaged product. So they want to go out and buy the product and support them. But the flip side of that is that the leverage works in the other direction as well. The success of the product is almost completely tied to people's opinion of that person. So if someone goes out and does something wrong or controversial, demand can basically take a nosedive as well. And that would be one advantage for the consumer packaged product because it's really more about the product than it is about any individual person. And that's really what it's about at the end of the day. The question is whether or not products like Mr. Beast Feastables can compete with generations of people eating Hershey bars. So I decided to try it out for myself. I went to my local Walmart, of course, and I picked up some Hershey bars, some Hershey nuggets because I love those things, and a couple of Mr. Beast milk chocolate bars. I mean, look, it's for research. If I'm going to get this stock analysis right, I need to eat candy bars. That's what we do on this channel. We go the extra mile for you guys. So my daughter and I tried it, and it was fine. I mean, it didn't taste as good as a Hershey bar, and to me, it kind of tasted like a knockoff chocolate bar. My daughter took one bite, put it down, grabbed her Hershey bar, and then went to her room. So I think that tells you what she thought about it. And she actually likes Mr. Beast, but I think the lesson was don't mess with her chocolate bar. And just a couple other points, the Feastable bar was actually double the price of the Hershey's bar. Now, it was also about 50% larger, but the price was double. And yeah, it only has like 5 ingredients and all that, and I'm sure that's like a marketing tactic, but at the end of the day, it just didn't taste as good or what I expected out of a Hershey bar. So the point is, creator-led brands may be a notable disruption, but at least in this case, I'm not convinced that it's a serious contender to Hershey's, at least not at scale. And in addition to my own personal evidence, Hershey's management team has addressed this risk by recognizing that they've been primarily focused on execution and meeting current demand. Innovation is going to be an area that they put more focus in going forward to remain competitive against creator-led brands or just traditional competitors as well. And just real quick, if you guys enjoy these type of breakdowns, my stock analysis library on Patreon continues to build. I post analysis documents on even more companies there, as well as additional content and member-only videos. I even added a 7-day free trial so you can see if you like it completely risk-free. So for more info, check out the link in the description. So now that we have a good idea of the pros and cons of their core business, let's take a look at how they performed operationally. Hershey's has grown their free cash flow 3 out of the last 5 years. Now, one of the outliers was 2020, likely due to the global pandemic, but the other was an 8% decline in the most recent trailing 12 months, which basically includes the 2 quarters from 2023. And now it looks like the primary differences from 2022 to the trailing 12 months are an increase in income taxes as well as an increase in accounts receivable, which is basically waiting on payment from customers. To me, those seem relatively tame, and the free cash flow generation seems strong. Their capital expenditures average about 5% of revenues, and they're generating around $1.5 billion in free cash flow a year. Hershey's management team does expect capital expenditures to be higher in 2023 due to capacity expansion and investments in digital infrastructure. Now, digital infrastructure investments can seem a little nebulous when it comes to shareholder value, but I do think extra capacity is going to be a good thing. And with that in mind, let's take a look at Hershey's profitability real quick. The gross profit margins at 43.92% versus sector median of 32.90% and a 5-year average of 44.95%. Their net income margin is 16.48%, which far outpaces the sector median of 4.16% and is higher than their 5-year average of 15.49%. And then lastly, their levered free cash flow margin is 10.56%, which again handily outpaces the sector median of 3.43% and is lower than their 5-year average of 12.44. So in general, even though in some cases their margins are slightly lower than their 5-year averages, they're still pretty handily outpacing their peers, which is definitely a positive thing. So let's take a look at Hershey's debt situation. So Hershey's has total debt of $5.2 billion and a net debt position of $4.8 billion. And that's because they have a total of $446 million of cash and short-term investments. And if we take a look at their interest expense, we see that it's really only about $150 million a year, and they're generating healthy, consistent cash flow. So I would consider their debt position relatively healthy. Okay, so I think we have a pretty decent idea of what's going on in their business. Let's take a look at their valuation. So if we take a look at their spreadsheet and the data that's been pulled in, we see their cash flow yield's about 5.96%. Obviously, they've had very good dividend growth. Their dilution trend is down. According to Morningstar, they have a wide economic moat. And have they ever outperformed the S&P 500? We already took a look and we know the answer is yes. So let's get to the discounted cash flows evaluation. So once we add our cash from operations, our CapEx, and our stock-based comp, we get a fair value price per share of $182.76. And now this is just a little bit under the current price for Hershey's, but let's take a look at our assumptions so we know how we got there. So in terms of starting cash flow, I'm using the trailing 12 months. Even though there's been maybe some slight variability in the numbers, they're pretty steadily growing. So I think in that case, trailing 12 months makes the most sense. In terms of starting growth rate, I'm literally just using the adjusted free cash flow growth rate here of 9.66. Now, if we take a look at our multiples model, we see that the peers that we're using are General Mills, Mondelez International, which I probably butchered that name, sorry if I did, Hormel Foods, and then Kraft Heinz. And as it relates to price to cash flow, we get a fair value price per share of $243.19, which is a good bit above the $195.04 that it's trading at today. It's just above our target price of $194.56 in order to have that 20% margin of safety. So this would definitely be an interesting price. Now, let's take a look at price to earnings. And obviously with the same peers, as it relates to price to earnings, we get a fair value price per share of $148.64, which is quite a bit below the $195 that it's trading at. And in this case, as you can see, as it relates to earnings, Hershey's is actually at the top in terms of PE compared to their peers. So that obviously is going to push their fair value down. So if we take a look at all of the valuation methods together, we see that the analyst mean price is actually $257.65, which is quite above most of our valuations except for the price to free cash flow multiples model. So if we take a look at historical price metrics for Hershey's, we see that as it relates to price to earnings and price to cash flow, it's beginning to trade in what I would consider a value range. Because if you go back over the last 10 years, there's really only been a couple points in time when it traded for this low of valuation. And that was, mid 2018, early 2019, and then obviously 2020 with the pandemic, and basically now. So having price to cash flow under 18, having price to earnings under 23, in general, based on history, to me, looks like it's getting into a value range, especially when you consider the fact that it's down almost 30% from its May high. So to me, Hershey's valuation looks to be at least fair valued and maybe a little bit undervalued because their free cash flow generation compared to their peers is strong and it historically trades for a premium. All right, so let's talk about my overall thoughts about Hershey's and let's grade it on the 3 criteria that I use to evaluate stocks: business, operational performance, and valuation. In terms of business, Hershey's has extremely strong brand recognition. They've had steady revenue growth for about a decade, and they've shown to be able to have pricing power. So from a business perspective, I would rate them as good. So from an operational performance perspective, they've shown dividend growth of greater than 9%, steady free cash flow generation for about a decade, and they have profitability margins that outpace their peers. So from an operational performance standpoint, I would rate them as good. So in terms of valuation, their DCF model is about 94% of the current price, and their price to earnings and price to cash flow metrics are starting to look attractive in terms of historical value ranges. So from a valuation standpoint, I would rate them as okay. So is Hershey's a buy now? So to me, Hershey's is a buy now because I'm looking for dividend growth companies that are starting to trade at more attractive prices with the most recent market downturn. Hershey's is a company with a wide moat consisting of their instantly recognizable brand names, pricing power, and a long history of manufacturing and distribution in the chocolate industry. They've had consistently upward revenues over the past decade with only 1 year of slight decline out of the last 10. Operationally, Hershey's has mixed good profitability with consistent free cash flow generation and good dividend growth. Their debt position is manageable based on relatively low interest expense combined with strong cash flows. And from a valuation perspective, Hershey looks to be at a close to fair value or even slightly undervalued based on discounted cash flows and historical price measures. Their free cash flow in comparison to their peers is a strength, and they tend to trade at a premium. So my personal buy rating for Hershey is based on their position in the industry as well as their consistency across many aspects of their business. And that's one thing that really stood out to me as I did this evaluation. Their consistency in terms of revenue growth, profitability, and overall performance just really stood out over the past decade. And even though there was some pockets of variability, of course, like any business has, in general, it was steady upward movement. And that level of consistency in terms of performance mixed with a strong core business is the type of combination that I look for in my own portfolio. Plus, in my view, the risks of their business seem rather tame and unlikely to have a large impact. Because could the government come in and mandate health stuff? Sure. Could people really make that switch to wanting healthier food options? Yes, but at what scale? And could competitors really come in and disrupt the whole industry? Of course they can, but are people really going to want something new, or do they want the thing that tastes like what they've always known for generations? And to me, the biggest question for investors with Hershey's is whether or not they can maintain the same level of revenue growth and consistency going forward, or if they've reached a saturation point. But other than that, with Hershey stock down about 30% from its 52-week high, investors will just need to determine what valuation or fair value price they're comfortable with. Now, I don't currently own Hershey, but after digging into them, they definitely fit the profile of the type of company that I'm looking for. So I'm going to be adding them to my watch list and likely adding them to my portfolio in the near future. But that's just my take on it. What do you guys think about Hershey's? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.